Yu-Dee Chang, principal and also chief advisor at ACE Investment Strategist. Also staying with us, our guest host Ian Bremmer from the Eurasia Group here at our Asia headquarters. Yu-Dee, I guess the good news is easy money is going to be here for at least a couple more months. Ahead of the FOMC, we had futures pricing in about a 66% chance of Fed funds going up to 0.5% by the end of the year. After the decision and the statement, it went down to 58%. Let me ask you though, markets, rates, even the dollar, how much have they priced in, if at all, these brewing U.S.-China tensions that we've just been talking to Ian Bremmer about?
Not much at all. I think as far as the market is concerned, that's pretty much in the back burner. What the market right now is focused on still, of course, is unemployment, is the GDP, and is the potential or the possible inflation down the road. I think other than that, market is really not thinking about anything else right now. It's kind of interesting. I think going forward, one of the pitfalls in the market that I believe is actually geopolitical situation. I think China situation could be one of the possibilities that actually gives a little bit of negative surprise to this market here.
I agree with you completely, Yu-Dee, and certainly in the last couple of days, that's what I've been hearing from all the Singaporean ministers and the rest I've been talking to, the financial movers. They're really concerned about this very much more than the last time I was in Sing. But what do you think it actually takes, specifically before the markets actually start reacting to this?
Yeah, I think this market right now is thinking, well, this is nothing that we haven't heard before. A year ago, basically, U.S. wanted China to raise its currencies. Basically, Chinese don't want to do it. So they're saying, well, this is a part of the negotiation process where U.S. is playing tough, posturing, and Chinese, of course, in return, is posturing themselves. Eventually, they'll pretty much come to a settlement and deciding on how much the renminbi should appreciate against the dollar. So right now, the market is saying, everything is going to get resolved.
Yu-Dee, as far as risks are concerned for the broader market and sentiment, have we factored in the possibility that we could see tighter scrutiny on the financials? I mean, clearly that is still a developing area, but has that been fully taken account of by the market, number one? And number two, what's going to be the Fed's next step in the normalization process? Is it going to be further tightening of the discount rate?
Yeah, I think answer the second question first. It's pretty much the consensus. The next step of the Fed will be to remove the language of the so-called extended period and also exceptionally low. That should happen in within the next two meetings, which means either April 27, 28th or the June meeting. And then after that, the Fed is expected to maybe start to move the rates up by about 0.5%. So that's what's expected by the market. By the way, although there's only 1 dissent vote that is from the current meeting, don't forget, most of the so-called hawks or the hawkish comments will be coming from the non-voting members, which will be start hearing them to talk in the next weeks to come. So that's on the Fed. So I think as far as factoring risk is concerned, like I said, I think the so-called geopolitical type of risks right now really has not been factored in by the market at all. The market, of course, is still worried about employment. That's getting a little bit better. Yeah. The Fed said it today.
Yu-Dee, on that note, we did have a warning by the Fed in its statement saying that household spending remains constrained. It's also worried about fairly tight credit, but at the same time it decided to terminate its mortgage-backed securities program at the end of the month, which could in fact drive up mortgage rates. Is this going to be an issue for markets as they watch what happens on the housing market?
Yeah, that's a possible issue. But don't forget, the Fed has pretty much already terminated 98% of that program already. That's a trillion program. And they did leave a little bit tail out there saying that they might possibly still considering buying more. But you're correct. I think right now today's talk is that, well, by Fed pulling out of the mortgage market, that would possibly bring up interest rate, which is going to in turn hurt the housing markets again. And that is the so-called second shoe. So some people are start talking about maybe we'll have a so-called double dip, but a very late session double dip.
Listen, always a pleasure talking to you, sir. Useful. Thank you for your time and ideas. Yu-Dee Chang from ACE Investment Strategist, and a lot more to come with Ian Bremmer from the Eurasia Group.